Thanks for joining us for our Corn and Soybean Outlook webinar. I'm Jim Mintert, Director of the Purdue Center for Commercial Agriculture, and joining me today is my colleague, Dr. Michael Langemeyer, who's the Associate Director of the Center and also a Professor of Ag Economics here at Purdue. We're going to talk a little bit about the corn and soybean outlook in light of the fact that USDA has released a couple of reports since we last spoke. And then, of course, was the planting acreage report that came out at the end of June, as well as the updated supply-demand estimates that came out just last Friday. So let's turn our attention to that information and start off by looking at the acreage. The acreage was really quite a bit of a surprise relative to the planting intentions. The planting intentions were for U.S. farmers to plant about 97 million acres of corn, but instead they planted about 92 million acres, at least as reported to USDA. So a downward revision relative to expectations going into that report of almost 5 million acres. And that still leaves us up 2.3 million acres compared to a year ago, but still a bit of a surprise and really kind of the biggest single change I think that we've seen over these last few weeks, Michael. As you look at what that implies, though, USDA is still using their trend yield estimates for the crop yield this year, and they're at about 178.5 bushels per acre, which I rounded off to 179 in this chart. But as you look at that, you can see that would be essentially a record high yield if we actually hit that trend. And so you put that acreage number together along with the yield estimate, and we're looking at potential for a pretty big corn crop. And as you think about crop conditions, this is the most recent set of crop progress report information that came out actually a week ago, because the new one will come out after this webinar late this afternoon. But as you look at the percentage of crop that's in the good to excellent category, notice where we are well above last year, significantly above 2017, a little bit below 16 and 18, but nevertheless, this is a crop that's off to a pretty good start. And we've had a switch in terms of expectations here recently. A week ago, all the talk was about dry weather and hot weather. In the interim, we've gotten some rain, not everywhere, but many locations across the Corn Belt picked up some rain. And the temperature forecast has changed appreciably. Temperatures here in the eastern Corn Belt this week now are forecast to largely be in the upper 80s to maybe cross over the 90 mark, but mostly in the upper 80s. That sounds like pretty good corn growing weather to me.
Yeah, we've got some critical months coming up here, but nevertheless, I don't see no reason why you wouldn't expect at least trend yield at this point.
Yeah, I think that's really the key message for us is 10 days ago, I think we were starting to think about the possibility of seeing yields fall below the trend. Now it looks like trend with a good, reasonable chance anyway, of even being perhaps a little bit above trend. And that's a shift just over the last week or 10 days. And of course, we've seen some of that reflected in futures prices here these last couple of days. Well, let's just kind of walk through the acreage and the trend yield assessment. That gives us a corn crop expectation of about 15 billion bushels. Those of you that have been watching these webinars on an ongoing basis know that when we looked at the data after the planting intentions report at the end of March, we were actually expecting a corn crop that could hit as much as 16 billion bushels. So that's about 1 billion bushels less than we were anticipating a few months ago, but still a large corn crop. And if we do push yields a little bit above trend, we're going to set a new production record here in 2020. Let's take a look at the demand side. And one of the big question marks for several months now, of course, has been what's taken place with respect to ethanol usage. USDA has reduced their ethanol estimate in terms of usage for the 2019 crop. They're down to, I think, 4.85 billion bushels. And they're expecting a pretty nice recovery into the 2020 crop marketing year, up to 5.2 billion bushels. And I guess I'll just say it, Michael, that strikes me as maybe being a little bit optimistic.
Yeah, there's certainly a pretty large band of uncertainty around that number.
Yeah, so let's take a look at what's taking place in the ethanol market. So here's gasoline and ethanol prices. These are based on the monthly averages from the Omaha, Nebraska, the unleaded gasoline and ethanol rack prices, or the wholesale prices really. And you can see the rebound. Rebound in both unleaded gasoline prices bottomed out, at 63 cents a gallon back in, I think, April. Improved to 75 cents a gallon in May, and then moved up to $1.30 here more recently in the month of June. And notice that ethanol prices rebounded as well. So that part looks pretty good. If you start looking at ethanol plant margins on a daily basis, these are the margin estimates that are published by Iowa State University's Center for Ag and Rural Development. Notice what's happened. A nice recovery relative to where we were in late March and the beginning of April, when we actually had some negative margins. And when I say a negative margin, that means those plants weren't even able to cover their variable cost of production, which is the classic shutdown decision, of course, and that's why so many ethanol plants did in fact shut down or severely reduce their production levels. So a nice improvement compared to where we were, but notice what's happened here in recent weeks. It looks like those margins have plateaued, and I think that's an indication of where we're at here this summer, as opposed to seeing those margins continue to improve. And of course, what that means is we're seeing a plateauing of the change in ethanol production. So this chart takes a look at the percentage change in U.S. weekly ethanol production compared to the first full week of January. And notice in the beginning of the year, we saw those ethanol production numbers running a little bit below a year ago, or a little bit below that first full week of January. And then as coronavirus really started to hit, those production numbers really collapsed. We saw production drop literally 50% compared to where it was in the early January timeframe. And then we had the recovery take place, especially in May and early June. But notice these last few weeks, we've sort of plateaued. And if I had to guess, looking ahead, I think that's really my concern, that we might see that plateau continue with maybe ethanol production improving a little bit to where it's been recently, but perhaps not get all the way back to where it was in early January.
And I think part of the problem is we're seeing a second wave of COVID-19 cases, but particularly in a couple of southern states, and I think that's going to prevent it from really improving from where we're at currently.
Yeah, I mean, and that's the concern for the corn market, right? If we don't get those ethanol production numbers back up, that's clearly a problem. So when I look at the ethanol estimate from USDA and their balance sheet that they published on Friday, I think they're a little on the optimistic side with respect to ethanol corn usage for this coming marketing year. And admittedly, they've got a lot of time ahead of them, right? Yeah. That marketing year doesn't get started to September, but it has built into it a significant recovery relative to where we've been recently. They're also forecasting about a 20% increase in corn exports during the 2020 marketing year. Their current estimate for the 19 marketing year is just a little under 1.8 billion bushels. They're projecting a recovery up to 2.15 billion bushels. Again, a significant recovery. And to get there, that's going to require some economic recovery in the importing countries, not just here in the U.S. So I think that's also a little bit of a concern. And then more recently, there's been some concern about feed usage. When the grain stocks report came out a couple of weeks ago, the grain stocks estimate was surprisingly large. And one possibility is that we simply weren't consuming as much corn for feed. The other possibility is that the 2019 corn crop perhaps was underestimated a little bit. So depending on how you want to look at that, either way, there's a little more corn out there perhaps than what we were expecting coming in. So a little bit of negativity there, although the livestock numbers here in the U.S. are still very large. We still should see pretty good feed consumption, but that is a little bit of a concern going forward. So where does that leave us in terms of ending stocks and prices? Ending stocks going to 18% versus 16% of usage coming out of the 2019 crop. The good news is that's smaller than what we were talking about.
Yeah, we were talking 20% or slightly higher.
Yeah, we thought at one point, following the planting intentions report, we thought we could see, with trend yields, the possibility of seeing that ending stocks get up in as high as 21 or 22%. So it is better than that, but it is moving the wrong direction. It's still larger than this year. USDA has backed off their price forecast for the 2020 marketing year to 335 from a 360 average here in the 2019 marketing year. So not a lot of good news so far, right? If you take a look at what's taken place on the corn basis side, this is from our crop basis tool on the Center for Commercial Agriculture's website that Nathan Thompson kind of maintains on behalf of the center. And he's got the update on there for last week, and you can see what's taken place with respect to corn basis. The current year is the black line. That blue line is the 3-year average. And, we saw the collapse in basis when ethanol demand dropped so hard. Then more recently, we've seen some improvement in basis, but basically what we're doing is just looking at a seasonal improvement that's matching that 3-year average. And I think really what we're looking at is we've lost the advantage that we had. That premium that we were getting reflected in terms of that very positive basis was really a function of the fact that we had tight corn supplies here in the Eastern Corn Belt in a region that had a tremendous amount of ethanol demand. And now that ethanol demand is much weaker, the reason for that strong basis has really eroded. And of course, as we approach harvest time, the need for a strong basis has eroded as well. So our forecast is that the basis will probably run pretty close to that 3-year average here for the rest of the summer, recognizing that basis in the summer can be kind of volatile, but nevertheless, certainly not a recovery back to what we were looking at in February and the very beginning of March. So let's look at what the futures market is offering us in terms of pricing opportunities. Just about an hour or so before we came over here to record the webinar, Dees Futures was trading at about 337. If we look at the basis tool and use that to generate a late September Central Indiana basis forecast, that comes out to about minus 25 cents a bushel, recognizing there's some variability around that. That implies an expected cash price, if you hedge today, at about 312. History would suggest if you're looking at doing some pricing today, if you want to do some storage, there'll be an opportunity later to roll that hedge forward into one of the deferred futures contracts and at a more favorable spread across those futures contracts. Those, particularly in a large crop year, the spread across futures contracts tends to reach a peak around harvest time. And so hedging into those deferred futures might not be the best strategy. You'd be better off probably hedging into December and then rolling that hedge forward. However, if you take a quick look at May futures was trading at about 354. Basis next April, again using the crop basis tool, maybe about a minus 10 cent basis. Put those two together, about a 344 expected sale price. And Michael, I guess if you think about is now a good time to hedge, well, maybe we should have had this webinar a few days ago, right? Before prices dropped hard on Friday and again on this morning.
But putting this in perspective, 344 doesn't sound like a great price, obviously, but there's a lot of downside risk in this market. I mean, you were talking about some of the negatives, that are impacting corn. Stocks could be higher than 18%. Exports are fairly optimistic. Ethanol demand looks fairly optimistic, and so even though that doesn't sound like a very good price, I mean, are you willing to take the chance that corn's going to plummet below 3?
Yeah, so I think that's really the issue, and it probably depends a lot on where you're at with respect to your own marketing program as to whether or not you make
storage,
sales,
how much storage you have.
Yeah, whether or not you choose to make sales today. But if you haven't done much in terms of making sales, as Michael just pointed out, we think there is downside risk from these price levels because as we think about the risk factors here, we've got a lot more on the negative side than we do on the positive side. Yeah. We're concerned about several components of demand. And then we also think there's a risk that we could actually see yields above trend. And so that's the way I would look at that. Just to kind of look a little more at the corn price structure, again, this was the price structure this morning with Dees at 337, March at 347, May at 354, July, small premium there, 359. As you look at it, though, getting back to what we were talking about earlier, if you place that hedge in Dees, what you're really anticipating is that the height of those stairs that I've depicted on the diagram would increase over time. And our analysis, really some analysis that Nathan Thompson's done with one of his graduate students, has looked at that pretty closely. And the odds are pretty good of seeing those the stair heights increase as you get into the harvest time frame, particularly in a year if we have a good crop, with the market providing a stronger incentive to store. And so in that environment, what you'd want to do is do your hedging, for example, in the Dees contract now, and then roll the hedge forward into one of those deferred contracts after those stair steps start to increase the height. So think about doing that. Let's take a look at the soybean side, Michael. A relatively small rise in soybean acreage versus intentions, despite the fact that we had the big corn acreage decline. And I have to say, that was a surprise.
That was a big surprise.
The expectation coming in was that if we took acres away from corn, they would go to soybeans. And in part, that was based on some analysis that you had looked at pretty closely with respect to how the relative profitability of soybeans had changed versus corn, right? So simply didn't happen, at least based on the planted acreage report.
There was a couple states that did increase soybeans quite a bit, which was worth pointing out. And the two states that probably increased the most from the planting intentions was Kansas. Kansas was looking at record soybean acreage, but also Indiana. For Indiana, there was almost a complete switch from going from corn to soybeans of about 300,000 acres.
So
there was some switching in some states, and there wasn't a lot of states where soybeans were down necessarily, with the exception of North Dakota. But the increases weren't as big as we thought they were going to be.
Yeah, and so the anomaly when you look at the state level data really was North Dakota.
Yes, definitely North Dakota. Their corn acreage was down quite a bit from the March 1, but also their soybeans. And so I don't exactly know what's going on there. I have not looked at the prevent plant data for North Dakota, but there's a lot of acreage there that didn't get planted to either corn or soybeans.
Yeah, so if you think about the reduction in corn acreage, I think that's also an argument for the possibility of yields being equal to or above trend.
Yes, yes, definitely.
So there's the planted acreage. Here's the yield numbers. Again, USDA is still sticking with the trend yield, which is about 50 bushels per acre. I think they're actually just a touch below 50, but if you round it off to 50 bushels per acre. A little different scenario here than corn. Corn, the trend yield essentially gives us a record high yield. The soybean side, not quite so true, would be still a little bit below the record. The record, of course, was 2016 at 52 bushels per acre, but truthfully, soybean yields are going to be determined about a month from now, or maybe 6 weeks from now, right? So if you look at the crop progress reports, the 2020 crop off to a good start based on the good to excellent ratings from USDA. Again, the critical period is really going to be more the month of August, but certainly off to a good start. And, again, you're probably looking at least a scenario of thinking the trend yield is very likely at this stage, given the fact that we've still got a lot of the growing season left. Where does that leave us in terms of production? Just a little over 4 billion bushels, 4.13. That was really very little change relative to what we've been talking about previously, because the acreage numbers didn't change much. But it is a significant rebound compared to 2019, up about 16% compared to 2019. Of course, we had that huge drop in acreage last year, which pulled down the soybean production numbers so hard. A little bit like corn, USDA is optimistic about exports, at least relative to what some of us might think. They've got soybean exports rebounding in the 2020 marketing year to over 2 billion bushels, up from 1.65 is their current estimate for 2019. That's a 24% increase. That strikes me as optimistic.
Yes. Yeah.
Obviously they've got built in there an assumption that we're going to see a larger movement to China, but also a recovery in some of the other markets as well. And so it's an optimistic forecast. Yeah. Again, we're a little bit concerned that we might not be able to hit that.
And to put that in perspective, I mean, I said this last time too, if you were watching the webinar last month, but that 2.05 is really close to where we hit in 16 and 17. And I just can't believe that we're going to go back to 16 and 17 in 2020.
Yeah, I mean, it does a couple of things. One, it makes an assumption about China, but the other thing it does is it kind of assumes pretty good income growth around the world, because the driver for both corn and soybean exports from the U.S. is really ultimately consumer incomes in terms of being bid into demand for meat. And that's the fact that I guess I'm a little bit concerned about.
And the reason why this is so important, we're going to get to a chart here, is this has huge implications on what the stocks to use is going to do in 2020. The stocks are much tighter in soybeans than they are in corn.
Yeah, so let's just take a look at those. Here is the stocks to use ratio plotted against prices. So the ending stocks numbers, we're basically at about 10% for the 2020 crop. That's down from about 16 or 17% for the 19 crop. So an improvement there. I mean, that's the good news. At one point, I think I had ending stocks down to about maybe a little bit below 9%, depending on what was going to happen.
Or right around 9.
So we're kind of flirting with that level at this point. So that's the good news, and obviously on a 2-year trend basis, a significant reduction in those ending stocks. So that's all good news. But from a longer-term perspective, we remain concerned about the demand structure, whether or not the ending stocks will really shrink as much as projected. USDA's got the marketing year average at 850. That compares to 855. They did revise the 19 number up slightly to 855. So, kind of a steady state on the price side, but recognize that there is clearly some risk on the demand side, I think, is how I look at it.
I want to pause here and point out a couple numbers that are going to be important when we talk about government payments here in a couple slides. That 855 for 19 and 850 for 2020 is obviously above the PLC price. Now, we were recommending Ark County, but even from an Ark County standpoint, that 850, well, the prices are a little bit lower than 2020, so maybe there'll be an Ark County payment in 2020. Well, the short answer to that is probably not, because Ark County is also based on yield. If we get trend yield or slightly above trend yield, our revenue is going to be strong enough with that 850 price that we're looking at very small Ark County payments for soybeans in 2020.
Yeah, good point. Let's take a look at the basis. So again, using the crop basis tool from our website, soybean basis, really a different story than corn basis. Soybean basis didn't weaken sharply like corn basis did when coronavirus hit. And really the different explanatory variable there is the fact that the main driver behind the weakening in corn basis was the reduction in demand for ethanol. And we didn't experience that obviously on the soybean side. But notice as you look at the black line, which is the current year, versus the 2-year average, which is the blue line on that chart, notice how the black line is approaching the average. And that's exactly what we think is going to happen here the rest of the marketing year. And then as you move into the fall, we think we're probably back to an average basis level. And we've been beneficiaries here in the Eastern Corn Belt of strong basis for both corn and soybeans for a while. We've lost that, I think, going forward.
Yeah, and a couple things there. I mean, the acreage has rebounded quite a bit in Illinois, Indiana, and Ohio from compared to last year. And again, if we have trend yield, you're looking at some pretty strong production numbers in the Eastern Corn Belt this year.
Yeah. So that means as you look at projections for hedges, you're going to be using some weaker basis numbers than what you've been selling beans at lately. I guess that's maybe a key point to remember. Let's take a quick look at the world stock situation, because if there is a good piece of information or news out there, it is the fact that USDA tells us that they think world stocks are tightening. Not dramatically compared to last year, but nevertheless the trend appears to be in the right direction. Keep in mind, though, that does make some assumptions about what's taking place with respect to economic growth around the world. And probably no year when there's been more suspicions about whether or not we're going to see the kind of economic growth that we've been experiencing in recent years than this year, right? So I think, again, I'm a little bit concerned that there might be a little too much optimism about the world stock situation as well, although it looks like it's trending in the right direction. So let's take a look at the soybean crop pricing opportunities. These are November 2020 soybean futures as of this morning. They were trading at about 876 before we came over to record the webinar. Late September, my forecast for Central Indiana basis, -50. Michael, you thought that was a little on the negative side, but I think that's realistic for this fall. It might be a little negative, but I think that's realistic. That implies an expected sale price of about 826. And when you look at the futures, the deferred futures on soybeans, there's really no storage incentive in there. In fact, there's at least one contract that was inverted. So if you're thinking about storing soybeans, if you have that opportunity in some on-farm storage, the way to look at that would be to do pricing in the November contract and then look for an opportunity to roll into one of those deferred futures contracts around harvest time. That's on a seasonal basis when the spreads across those futures contracts tends to hit its peak. And so that would imply maybe late September, early October, somewhere in that time frame, there'd be an opportunity to roll those hedges. On the corn side, you'd probably want to roll hedges maybe a little bit later than that, more typically maybe late October or November. But in both cases, you probably don't want to lock in the current futures price spreads, take advantage of the fact that those spreads are likely to widen, and that would improve your returns to storage over time. So you mentioned the Ark County and PLC situation. Let's review that, because I think that's going to be an important component for people's cash flows here, Michael.
So let's review the programs again. Ark County for soybeans and PLC for corn. Just remember, Ark County is based on crop revenue, and is the crop revenue below that Ark County guarantee? With relatively strong yields, even with that $8.50 price, that really is increasing the revenue for 2020 compared to that revenue guarantee, and it makes the payments look relatively small. Depending on the county you're looking at. For the case form I was looking at for White County, which we're going to be talking about here in a couple slides, I was looking at 2020 Ark County payments of $0. Remember the PLC, this is most relevant for corn and wheat, $3.70 for corn and $5.50 wheat. Certainly for corn, we're looking at a price south of $3.70, so good potential for PLC payment for corn in 2020. Let's look at this for the White County. I'm using a 2019 corn price coming from the WASDE report of $3.60. And then I'm looking at 2020 prices on the horizontal axis, $3, $3.20, $3.40, $3.60, $3.80. The price, the USDA current price estimate is $3.40, so let's focus on that particular number. If you look at 19, it looks like a small payment in 19. It's a dime difference between the PLC price and the $3.60 price, so a small payment, small PLC payment in 19. In 2020, it looks like there could be a pretty strong payment, around $40 per acre at $3.40. If you go down to the $3.35, it's about $45 per acre. That is smaller than what the payment was about a month ago, because about a month ago we were looking at $3.20 corn. So let's look at, that's a possibility certainly that corn could be $3.20 next year, given what Jim talked about earlier. And so at $3.20 we'd be looking at a payment of about $65. And so the payments don't trade one for one with the price, but we have to remember that if price declines, we get less crop revenue. Obviously, we make some of that up with a stronger PLC payment.
Yeah, so your range in terms of projection for 2020 received in the fall of 2021 would be about $40 or $45 to maybe $60 or $65 an acre.
Yes, that would be a
for
safe range.
For this sample farm.
Yes, for the sample farm.
Good point. How about on the soybean side?
On the soybean side, this is not near as encouraging. It looks like it's going to be an Ark County payment for 2019 for this county, and that's true for a lot of counties in Indiana, particularly central Indiana and northern Indiana. But if you look at 2020, it doesn't look like there's a very good chance for a payment if soybeans stay at $8.50 or around that price. It looks like the Ark County payment is going to be close to $0.
Okay. So substantial corn payment, likely
small
little or no
small
soybean
to
payment.
Zero soybean payment.
Okay.
And so let's compare 2018, 2019, and 2020 payments for this county. In 2018, we did not have an Ark County PLC payment, but we did get an MFP payment. That was almost exclusively soybeans, but averaged together in a corn-soybean rotation, $52 per acre. Looking at 2019, we did get I am expecting a approximately $20 payment. That's probably a bigger payment for soybeans than corn in 2019, average around $20, and then a strong MFP payment in 2019 of $62. And so notice that's about $80 there in government payments in 2019. Let's look how 2020 compares to 2018 and 2019. So in 2020, expecting a pretty good payment for corn and no payment for soybeans. You average those two together, and it's around $25. CFAP payment around $21, assuming that about half of the 2019 crop was still in storage on January 15th. That is a strong assumption, but that's what I'm assuming here for the CFAP payment of $21. If there was nothing in storage on January 15th, that payment would be $0.
However, if there was nothing in storage, that means you probably sold the crop at higher prices.
That's actually, it would actually be positive.
Yeah, right.
Like I tell a lot of people, you don't really want a government payment necessarily. That's true with Ark County PLC and CFAP. You'd rather have the higher price.
Yeah, exactly. So how about some net return projection? Let's talk about that.
These are the same definitions we've been using in past webinars. Net farm income, gross revenue minus cash expenses and depreciation. We exclude opportunity costs on operating family labor and opportunity costs on owned machinery and owned land. Net return to land, we're getting a little closer to an economic return here. The only thing we're not including is an opportunity cost on owned land, and so this is directly comparable to cash rent. Net return to land is relatively low compared to cash rent. That suggests that there could be some downward pressure on cash rent. So I've updated the chart here for the West Central Indiana case farm, or corn soybean rotation, dollars per acre. It's a little more optimistic this month compared to last month, but it still does not look very good. If you look at that triangle for 2020, you're still looking at a negative net farm income. And remember, net farm income is used to pay for operator labor, family living. In other words, it's used to make payments on long-term debt. It's used to buy machinery, and so the net farm income there still appears negative. The actual government payments is a smaller bar because we lost a little bit of payment out of the PLC program, in particular with a slightly higher corn price forecast for 2020, and it looks right now to be similar to 2015, which was not a very good crop year, and so we had a very low net farm income in that particular year.
Yeah, so what jumps out at me when I look at that chart, Michael, is you've got 13, I think, years of data, and only 2 years with that net farm income in the negative category, right? 2015 and 2020. So that looks pretty rough from that standpoint. And then, obviously some uncertainty there, but it's kind of hard to get optimistic enough to push that all the way back up to break even, aren't you?
It'd be very hard to paint a picture where that could be possible without a very large increase in corn prices, which does not seem very likely. Yeah. And so one of the things that could happen is we're using trend yield here. If for some reason we were 10% above trend, that obviously would help. That certainly helped in 17 and 18. Particularly 17. That actually would have been negative without above trend yields in that particular year. And so that they're kind of hanging our hat again on strong yields.
So we do the Ag Barometer survey every month, and one of the questions we've asked periodically, and we've been asking it a lot lately, is do you expect your farm's financial performance to be better than, worse than, or about the same as last year? And people did feel a little better about things in June. We did this survey, I think, the week before the crop report, the week before the planting report came out, the third week of June. So 42% in June said that they thought their farm would have worse financial performance this year than last year, and that compares to 54 and 55% that felt that way in April and in May. So that's the good part. But if you compare back to the spring of 19, for example, in April of 19 and April of 18, notice the difference on the left-hand side. People were substantially less pessimistic, I guess is how I'd say, compared to this year. So things from a farmer perspective were looking a little better in June than they were earlier in the spring, but clearly there's a lot of concern out there with 4 out of 10 farmers telling us they expect worse financial performance this year than
and certainly that has an impact on working capital. That's probably the most serious consequence of this is we already had 20% approximately of the farms that had very low working capital that gave them very little flexibility. This is going to worsen that.
Yeah, and I think our survey reflects the fact that people are concerned about that. So, this was the chart that caused us to think that maybe we'd see more soybeans.
Bigger shift.
In terms of acres. But
yeah, this chart is very similar to what we've been showing the last couple of months. A huge advantage towards soybeans, and we did see an increase in soybean acres in Indiana away from corn, but for other states that we just really didn't see that big a shift. Which was a bit of a surprise. But as we've mentioned before, this chart does not look identical for the Western Corn Belt. For the Western Corn Belt, there's usually, in a chart like this, there's there's still probably an advantage to soybeans, but it's not near as big.
Yeah.
Because they have more upside on the corn yields than we have here in the Eastern Corn Belt.
Yeah, good point. All right, let's talk about cash rent and returns to land.
Yeah, my favorite chart anyway. I don't know if this is Jim's favorite chart, but it's my favorite chart. It's not that this chart is optimistic. It's just I think it does a good job of explaining what might be happening to cash rents in 2021. And when we talk about cash rent and net return to land, you're usually talking about a 1-year lag. And so the net return to land in 2020 impacts the cash rent in 2021 and perhaps a year or two past that, depending on if you have 1-year contract, 2-year contracts, or 3-year contracts. And so when we look at this green bar for 2021, my projection here, and we're looking at a net return to land of $120, that could possibly have an impact on cash rent in 2021. And so I did want to make sure I mentioned that. But I also look at the difference between cash rent and net return to land. And as we've said before, there just is a very large difference there between those two. It's the biggest difference we've seen here in the Eastern Corn Belt since 2015. And in 2016, we did have a fairly large reduction in cash rent in response to that. And so certainly there is some downward pressure on cash rent moving into 2021. I did some computations for below average productivity land, average productivity land, and high productivity land. There's a lot more downward pressure on below average productivity land and average productivity land than there is on the higher productivity land. And so in northwest Indiana and central Indiana and perhaps even parts of northeast Indiana, there's going to be less downward pressure than there is in the southern part of the state, based on my computations.
Of course, that's a little bit of a continuation of a trend, right?
Yes.
The budgets have suggested there'd be more downward pressure on the lower quality land for several years, and it's had trouble.
And it hasn't really materialized.
It hasn't happened. So,
but when it comes on the average productivity, then you start thinking that there might be some downward pressure for the state. Because the difference right now, or the erosion in working capital right now, plugging in futures, plugging in expected prices for the next 5 years is not real optimistic for the average productivity. You're looking at a pretty large erosion in working capital per year, $50 or more. And as I said earlier, there's some people that can't afford working capital decline $50 or more for 2 or 3 years in a row. They just don't have any working capital.
And as I look at this chart, Michael, when I see that kind of a gap between the net return and cash rent, I can't help but think we're going to see some significant downward pressure on cash rents unless we have a follow-up government program that would provide some additional cash flow. And truthfully, the MFP program probably did support cash rents these last couple of years.
That's definitely the case. And those of you that have been watching us for a while, you probably said, well, you were pretty pessimistic in 18 and 19. That's because I wasn't factoring in the MFP payment. And so if we got an MFP payment around $50, $60 per acre, that green chart would look a lot better, and there'd be a lot less pressure to reduce cash rent.
Yeah. So, but as it stands today, this is the way it looks, right? Yeah. So, okay. So one of the other questions we ask farmers on our Ag Barometer survey pretty routinely is what their farmland price expectations are. We ask it a couple of different ways, but this one is focused on the 5-year ahead outlook, the longer term outlook. And notice that there was a significant improvement in optimism there from May to June. In that March, April, May timeframe, we had between 40 and 44% of the respondents expecting higher farmland values 5 years ahead. On the June survey, that came in at 55%, which is not the highest it's ever been, but it's not too far off the high. The high is 59%. So that was kind of interesting to see that kind of rebound in optimism. And I think you and I have been talking about this for quite a bit. We've been talking about the fact that we think there's going to be some downward pressure on cash rental rates because of the lower returns. Yeah. But we're not convinced we're going to see that same kind of pressure on farmland values, and you might elaborate on why.
I think the key reason is low interest rates. I mean, I just don't see a scenario where the Fed's going to increase interest rates more than a percent or two in the next 5 years, and probably not even that high. Probably not even 2%. It all depends on the economy. As long as the economy stays relatively weak, there's a tremendous pressure for the Fed to keep those interest rates low. But yeah, I just don't see us returning to interest rates before 2007 in the near future. And that makes you more optimistic on farmland, because low interest rates increases farmland prices. It's same as it would real estate, the same as it would S&P 500 index.
So for clarity there, you meant 2027? You said 2007.
No, I don't think we're going to return to interest rates before 2007. That was my point.
Oh.
Yeah.
Okay.
I don't think, and in other words, way they usually refer to that normalized interest rates. I just don't think, I think we are in a new normal for interest rates. They're going to be relatively low.
And I would tend to agree with that. And so the other way to look at that, of course, is just the fact that there's a lack of alternative investments for people to put cash into. And that's probably also one of the factors that's been supporting the stock market. Again, this is another alternative investment. And it doesn't take a lot of non-farm investors to have an influence on the farmland market. And maybe we should talk a little bit about the factors that are impacting land values.
Yeah, there's several positive influences besides low interest rates. I think most would agree that land is a very thin market, and there's a particularly low supply of land for sale right now. Given all the uncertainty, that's not a big surprise. Also, land is a good hedge against inflation. So if something would happen here, and we did see a pop in inflation because of Fed policy, that's actually positive to land. Some studies we've done here at Purdue suggest that land is even better than gold as a hedge against inflation. So that's very positive, even though we don't expect inflation to be very high. It's still positive. And then this is investment potential for non-ag buyers. Look at CD rates, Treasury bills, they're really low. Even the long run T-bonds, the rates are really low, and so they're naturally going to look elsewhere. S&P 500, real estate, in cities, and then also farmland. And as you said, it doesn't take that much of an increase in interest in farmland. You see that to be a very positive factor, and so it's not like there's going to be a lot of people investing in farmland, but we're expecting that to be have a positive influence, a tick up, because they're particularly pension funds are looking for other places besides the S&P 500 to put their money.
One way to think of that is that non-farm investors can effectively provide a floor.
Yes, that's a very good way to put it.
And so if there is a bargain out there, that's what they're looking for.
Yeah, they're going to look at the fundamentals, and if it looks like it's a good buy compared to the fundamentals, they're going to put their money in farmland.
But in a market that's characterized by a relatively thin supply of land that's available for sale, it doesn't take very many of those investment opportunities to have an impact on prices.
But those positive influences really help explain why these relatively low net returns we're looking at for 2020 and probably for 2021, without some substantial government payments, are not going to have the expected negative impact on land values. These positive influences are too strong to see us pull down land values strongly in response to the low net returns. The working capital is depressed. That is going to hurt some farmers that might be interested in farmland, but quite frankly, even though there is a group of people out there with low working capital, there's still some people out there with strong working capital, and it doesn't take many of those to be interested in farmland to help keep prices up.
Yeah, so this is a little unusual. We're fairly negative on cash rents, but actually we're not really forecasting an increase in land values, but we're just saying that we don't think the reduction in cash rents is going to have a negative impact on land values.
I think stable short run, and I'm with that other 55%. I think 5 years from now we're going to see stronger land values.
Okay. Well, that kind of wraps up our webinar for today. Our next webinar will be coming up in August, and we're going to do something that kind of replaces a press conference that we normally do at the Indiana State Fair immediately following the release of the August crop report. So we'll be doing that as an online webinar in light of the fact that the State Fair has been canceled for this year. So We'll have more details on the website where you can kind of check in and register for that, but that'll be on August 12th. Just check our website for information, and of course those of you that are on the email list will get an email as well. So with that, on behalf of the Purdue Center for Commercial Agriculture and my colleague Dr. Michael Langemeier, thanks for joining us.